Hello, this is Nick Rach with the Earnings Scout, and today I'm going to review the earnings per share estimate revisions for Hortonworks. Before I begin, though, I want to talk about the requirements that we use for our ES indicator scores. Our ES indicator scores are a ranking system from 1 to 100 that we use to derive our recommendations for stocks. To derive an indicator score at the Earnings Scout, we need roughly 2.5 years of historical earnings per share estimates. So we need that much history because we just don't want to tell you who has the best revisions over the past 30, 60, 90 days. That's traditional momentum models do that. What we're doing is testing the short, medium, and long-term trend, measuring the durability and sustainability of that momentum, because that's the most important thing that we want to measure statistically. Is we don't want to tell you who had the best revisions in the past. We want to tell you who's going to have the best revisions over the next year. And we need a lot of data to be able to statistically determine that. In the case of Hortonworks, it IPO'd in December 2014, meaning we don't have 2.5 years of historical earnings per share estimates for the company. However, we are building history on it. We have about 700 companies that we have in incubators like Hortonworks that don't go into our live database, but we're building the history and looking at the earnings per share revisions, trying to determine what's going on. And once it gets enough data, then we'll put it into the ranking system into our live database and create an indicator score. So we're not going to say we have enough history on it to say whether Hortonworks is a good long-term investment, but we can still analyze the earnings per share estimates and make some conclusions here, mainly more from a trading perspective. So let's take a look here at our chart. We're just going to show you how Hortonworks stock has underperformed in the last year. This red dotted line in here, we're going to draw the trend line down. Really since April 2015, stock's down almost 70% since April 2015. That's the first thing we're going to look at. And whenever I see a stock that's down 70%, the first thing I'm going to ask, is it a screaming buy? You know, I love to buy things that are down so much. Or is the stock going to zero? And of course, it could do many points in between these two broad-based questions. But I think those are the two questions as an investor you need to think about. And we're going to look at the earnings per share estimates for Hortonworks to try to determine whether that's the case. In the case of the chart, we pull back up here. We know the red dotted line is the price of the stock. That's gone as high as $27 down to $7 and some change through the end of October 7th. We're going to draw the line in here because what we're going to draw in here is an earnings score. These blue lines here, I got the arrow showing up, is measuring the overall rates of change to Hortonworks earnings per share estimates. Multiple quarters, multiple years out into the future. We don't care about current earnings. We don't care about last year's earnings. We're looking at future earnings and measuring the deltas to those expectations across time. And in the case of Hortonworks, if you're above this zero line, that means on an absolute basis, your overall blended earnings expectations that we measure are going up on an absolute basis. Below this line, they're going down. Now, we always say this. It doesn't matter if earnings estimates are going up or down. It matters if they're getting better or worse, and can they be sustained in that direction. In the case of Hortonworks, what we've seen here is what we're looking just in this short time is we see no sustained earnings trend whatsoever. And this is only with 1.5 years of data. We need more data to even determine that. But even in this 1.5 year period, you're going to see there's no sustained trend. Let us show you what we mean. So when we look at Hortonworks and you go to the summer of 2015, after the company reports in roughly the second quarter earnings season of 2015, after it reports its earnings, its overall estimates about the future go down by a rate of about 20.39%. And then really in the fall of 2015, the estimates are getting cut after it reports at a rate of 8.12%. Less bad. That's actually a good thing. We actually like that. And then by the spring of 2016, estimates on an absolute basis are rising by 16.41%. Now, this is only basically over roughly a 3.5 to 4 quarter trend, but it's going up. Now, we need at least a 2-year trend, a 1-year trend, and even a 30-day trend. We're measuring multiple time series here to see what the slope of the lines are. But if we were just looking at the period from April 2015 to March 28th, roughly on the chart, we would see an improving trend, and we would like the stock, and that would tell us something good about the stock, that it would be worthy of a buy at this point. And you could actually see it. It actually did. It's hard to see on the scale here, but there was a little bit of divergence when the price did drop after from really the the low 20s down to the around the $8 range, the stock actually did pop back up to 11. But what we see here is while the estimates were going up by 16.41%, then after a couple quarters later, in really the summer of 2016, really May of 2016, we're seeing the estimates then get cut by a rate of 15.54%. So in this 1.5 year period, we have earnings estimate trends getting better, then getting worse. That's the inconsistency and no sustainable trend that we see from Hortonworks in just a 1.5 year period. And what we like to find is consistency in trend. We're not getting that with Horton. But I want to show you from a trading perspective. So from a long-term investing perspective, A, we don't have enough data, and B, even the data we have for the 1.5 year period for Hortonworks suggest inconsistencies. But if you can be nimble and you're a trader here, we want to show you a divergence. We showed you that little bit of a divergence that occurred really in May of 2016 that maybe created an opportunity here that's really coming on, because in May of 2016, estimates were being cut at a rate of 15.54%. And then in second quarter earnings season, we're seeing the estimates only get cut by a rate of 4.75%. And now we're seeing the stock ahead of the third quarter reporting season here. And Hortonworks is going to report on November 3rd, 2016. We're seeing the stock significantly sell off, while the earnings estimate trends are still improving here. So you can buy improving earnings estimates for a drop in price over the last two quarters of almost 40% peak to trough. So that tells us, at least in the near term here, the stock is oversold. But this is from a trading standpoint. So why is this divergence occurring? Because why is the price dropping here ahead of the earnings estimates? What we want to say is if you can actually determine that the earnings estimates can at least be only dropped by 2% here after the company reports in November, or be maintained or even raised, there's a wonderful opportunity here for a quick pop in the price for this stock. Now, from a long-term investment standpoint, still not enough data to determine that it's on track for a sustainable earnings momentum. But what we see here is a near-term divergence that active managers can exploit, particularly if you're nimble enough to be a trader. So while we need roughly 2.5 years of data, we cannot determine if Hortonworks is still a good long-term investment. We just can't do that. But from the short term, it looks like the stock is oversold, at least in the near term here, because we see those 2-quarter trends of improving earnings estimates on a 40% drop in price. So what we would recommend is look at our divergence that we highlighted for you, combine it with either some technical analysis or some good qualitative analysis, good fundamental research here. Look at the current estimates, where they stand. If you think they can be at least maintained here or certainly go up, this stock can certainly pop and pop quickly. This is going to be a high-risk, high-reward type stock that could create an opportunity from a trading standpoint, roughly. When we get more than 2.5 years of data, we'll start to put in our database and compile an indicator score. But at least from what we're seeing here, long-term investment, we would still stay on the sidelines. But if you could be nimble enough to be a trader, combine it with some technical analysis, some good qualitative fundamental research analysis on top of that divergence we spotted, you might have a good trading opportunity here in Hortonworks. So if you like what you see on Hortonworks, you want to learn more, you can contact our sales and marketing team on the screen here, or give us drop us a line at support@earningscout.com or even sales@earningscout.com, because we do analysis like this on 4,500 other companies on every sector and industry within the economy. We have rankings on, and we'd be happy to do portfolio analysis for you as well. So thanks for listening, and good luck investing. Thank you.